Thanks for clicking! Canada's fixed mortgage rates are heading upward as Trump tariff uncertainty sends bond yields, both Canada's and the United States, higher. Yeah, while regular viewers will be well versed in this concept, it's the yields on 5-year Government of Canada bonds, heavily influenced by the US 10-year rather than that of the Bank of Canada, which dictate our fixed mortgage rates, up 30 basis points over the past 2 weeks after falling by nearly 60. Yet, as we discussed before on this channel, and even the New York Times points out, this really shouldn't be happening. During times of uncertainty, we should be seeing yields on the 10-year fall as investors pile into what is usually considered the safest asset in the world, US debt. But that's not happening this time around. And as to why traditional market mechanics are changing so quickly, there are a number of explanations being floated, with some thinking China or Japan are dumping US Treasury bonds, others are saying hedge funds are selling their assets in order to cover their loans, with others speculating that US assets are no longer seen as safe as they once were, with other explanations from various groups abounding.
Some dude, this
And while there aren't any clear-cut answers, as we'll see today, something indeed has changed, and mortgage rates are heading upwards because of it. So what I want to do today is go over Canada's rising fixed mortgage rates, take a look at what's been happening with bond yields, go over some competing explanations as to why yields are up, and then discuss some implications. As of Monday, in addition to the uncertainty we're about to discuss, the president is now floating with the idea of terminating the Fed chair, and markets and interest rates are responding accordingly. We will obviously continue to track how all of this uncertainty affects us here in Canada. Make sure you click like and subscribe if you want to get those updates, but for now, let's get into these mortgage rates. Onto the mortgage rates. I am going to go over these a bit quicker than usual, as I think the reasons for why the mortgage rates are rising, rather than the rise themselves, is more important for our purposes. First off, my best 5-year fixed insured mortgage rate. An insured mortgage, if you'll remember, that's where you have less than 20% down. You have a 25-year or less amortization, or 30 for first-time homebuyers. You qualify at the greater of the contract rate plus 2% or 5.25, whichever is highest. And of course, you pay the mortgage insurance. My best 5-year fixed insured rate in March was 3.84, and that bumped up to 3.99 in April, with variable sitting at prime minus 1.01 or 3.94%. So, for the first time in a long time, variable rates are actually marginally better than that of fixed, as fixed mortgage rates are up and the discounts on variable are getting a little bit better, though that doesn't necessarily mean pile into variable. In fact, fewer and fewer are, but that's a different discussion for a different time.
All the kids are doing it.
Next, my best 5-year fixed insurable mortgage rate. An insurable rate, if you'll remember, that's where you have that 20% down, have a 25-year amortization or less. You qualify at the contract rate plus 2% or 5.25, whichever is highest, and of course you do not pay that mortgage insurance. My best 5-year fixed insurable rate in March was 3.99. That's now up to 4.09 in April, with variable sitting at prime minus 0.81 or 4.14%. So again, with fixed rates on their way up, getting very, very close to that of variable. And finally, my best 5-year fixed uninsurable rate. An uninsurable rate, if you remember, that's where you do have that 20% down. You have an amortization up to 30 years, or you take money out of your home. You qualify the contract rate plus 2% or 5.25, whichever is highest, and you don't pay the mortgage insurance. Uninsurable rates were actually down, but they were artificially high in March. In March, rates were sitting at 4.49 and now sitting at 4.25, with variables sitting at prime minus 0.45 or 4.5%. So we have insured rates, those with less than 20% down, up by about 15 basis points, insurable rates up by about 10 basis points, and uninsurable rates down by 25 basis points or 0.25%.
I tried to warn you, yes.
Now, I should note that those are all fully featured mortgage rates. You can always get a bit of a discount if you go for one of those fine print specials where you can't break your mortgage without selling, or you have to give your firstborn if you do break your mortgage. But if you know for sure you are going to keep the home for the duration of the mortgage, then it might be worth taking a look at those discounts. So, fixed mortgage rates have been moving up since last month, and given the amount of economic uncertainty, we really shouldn't be expecting them to be moving that way. Normally, anytime there's an international crisis, we'll see bond yields plummet and mortgage rates follow. We saw it in March of 2023 with Silicon Valley Bank. We saw it in October of 23 with Israel-Hamas. And more recently, we actually saw it with the Trump tariffs. And of course, the reason why, as you'll remember from previous videos, that's because a bond's price and its yield are inversely related. Say the big banks are holding a bunch of bonds that they bought for $100. Those bonds are going to pay off $5 at maturity, meaning they are yielding 5%. But let's say an international crisis occurs and investors need to buy some safe assets, so they bid up the price of those bonds, buying up those bonds for $104. Those investors will still be getting 105 at the end of the term, but they paid 104, giving them a yield of 0.956%. So the price of those bonds increased, their yields decreased. And we had been seeing this effect at work vis-a-vis the Trump tariffs. Right up until this point, on April 4th, shortly after Liberation Day, which initially sent yields lower and then really not, as bonds sold off worldwide amid the Trump chaos. And this was a big unexpected shift. Rather than investors piling into US bonds sending yields down, they sold off. They sold off to such an extent that there were already calls for the Federal Reserve to step into the market, start printing up cash, to buy up those bonds.
I'm calling Daddy!
And then, as we discussed in another video, Trump agreed to a 90-day pause on those tariffs, and that appeared to stop the bleeding. Yields stopped surging upward, the Treasury sell-off stopped. But while that 90-day reprieve seemed to have stopped the bleeding, yields didn't return to where they were pre-Liberation Day. Not in the United States, and definitely not in Canada. And to understand what this means for us here in Canada, what it means for our yields and our mortgage rates, let's go over the multiple competing explanations as to what caused the yields to surge in the first place. As mentioned, some said it was Japan and China, the first and second largest holders of U.S. debt, selling off bonds, dumping treasuries onto the market in retaliation to the Trump tariffs. Yet some are questioning the validity of that rationale. For Japan, that would have been a great big step to take against an admittedly tumultuous relationship with an ally, and even Japan's ruling party chief said the country shouldn't take that step. And whether or not it was China, though we won't find out for sure until the US releases its portfolio data as of June 18th, that Treasury sell-off does appear to have stopped, whereas the rancor with China definitely has not. One would think that if China was dumping treasuries in order to halt the tariffs, and the tariffs still were not halted, that China would still be dumping treasuries, when obviously they are not. And further, as some have pointed out, China very much needs its holdings of US treasuries. Remember, China doesn't float its currency like we do here in Canada and the United States. Rather, it actively manages its value, and to do so, it needs access to an awful lot of dollars in case it ever needs to prop up that value. In case it ever needs to buy back its currency out of the market, it needs dollars to do so. In order to get dollars, you need US treasuries, which you can sell to get your hands on dollars. Regardless though, if it was Japan or China, then that indeed was a great big shift. And a reminder that external forces can increase residential mortgage rates at the drop of a hat. But if not Japan or China, then some point to the idea that it could have been hedge funds doing the selling off. Brookings says it's possible that hedge funds needed to raise the cash quickly and sold off its treasuries. So a hedge fund borrows a bunch of money to buy stocks, then as a result of the Trump tariffs, the value of those stocks go down, the hedge fund gets a margin call, meaning the lender of that money that was used to buy those stocks needs that hedge fund to put up some value, needs that hedge fund to put up some collateral, and the easiest way to get that collateral, to get that cash, is to sell treasuries. And then, of course, others, myself included, said it could have been the bond vigilantes. Investors imposing fiscal discipline on governments they view to be acting either A, irresponsibly, or B, even worse, inflationary. Acting in a manner that will result in inflation, thereby undercutting the real returns of any investments made vis-a-vis those bonds. Regardless of who it was, though, whether or not it was Japan, it was China, it was hedge funds, it was the bond vigilantes, it was, in fact, someone, some entity, or a collection of entities with enough juice to move the market, and they did, in fact, move that market, sending Treasury yields up 60 basis points within a very short period of time. And, though it's now down from those highs, the yield on the 10-year is still far, far higher than it was just a few weeks ago. This wasn't an isolated episode. Investors are not, as of yet, piling back into U.S. Treasuries, even with a yield well over 4%, even with U.S. inflation coming in much better than expected. And just in the past week alone, we've seen multiple reports of investors, government institutions, questioning the safe haven status of U.S. Treasury bonds. And of course, we don't just need to look at the US Treasury market to see that its safe haven status might be dwindling. We can take a look at the gold market, which has seen some major increases over the past few months amid shifting safe haven preferences. So there is a shift occurring away from the United States as the most trusted partner in the world. And as we can see with the yields on US Treasuries and hence the yields on the Canadian government bonds and hence Canadian mortgage rates, that shift is not free. Now, all of this, of course, isn't to say that Trump isn't playing 9D chess, 9-dimensional chess, and the rest of us mere mortals just don't understand the wisdom of driving up US borrowing costs, threatening central bank independence, removing trillions of dollars from the stock market, and angering the majority of US allies.
It's better that you've apologised.
And it's actually certainly not to say that the US days are numbered as of tomorrow. The US will remain the most dominant power in the world for the foreseeable future. But what it is to say is that, as a result of these moves, markets, the economy, mortgage rates are not working in their traditional manner. And as such, expect more volatility and conduct yourself accordingly. I wouldn't bet on lower rates anytime soon, but I also wouldn't bet on higher rates anytime soon either. It's an incredibly uncertain time. And as we've seen over the past few weeks, the old mechanics, the old ways of doing things where there's a crisis, even a US-induced crisis, and as a result, the US and Canada all get to borrow cheaper, that may not be the case anymore. Things might not be like that for a long time. With that said, we will obviously continue to track these US moves and how they affect us here in Canada on this channel. Make sure you click like and subscribe if you want to get those updates. But for now, thanks so much for watching.